Without question, the major theme of the third quarter was the Federal Reserve's decision not to begin tapering its bond purchase program. As a result, risk assets did very well for the quarter, and interestingly enough, even high-grade bonds, particularly in the United States, posted modestly positive returns. Let's take a look. Now, we know that U.S. equity markets have been doing well for some time, and that continued. But equity markets in many parts of the world actually posted pretty solid returns. Also, credit markets did quite well as overall yields fell in the space. Global high yield generating 2+% returns, and as I mentioned, even within high-grade bonds, modest to modestly positive returns. Now, as we look forward, the bigger discussion is probably going to be in two parts. One, what about fundamental growth? And secondly, what about the decision to taper as we move forward? Well, first, the fundamental economic backdrop is much the same as it was this year. We expect modest, positive, but unspectacular growth next year, with perhaps the twist that developed markets are beginning to close the gap a little bit with emerging markets as the U.S. continues to generate positive returns, Europe emerges from recession, and Japan, through Abenomics, continues to post reasonably solid growth as well. But that's not the big question everybody has. The real question is, as we move forward and the taper does begin and we move to try to increase the federal funds rate, how should I think about my bond portfolio and performance? Well, as you can see here, the Fed funds rate has been low for some time. But we can get an estimate of what's going to happen over time by employing something called the Taylor rule. Now, in this case, the inputs are unemployment and inflation to give us a sense of what the path, possibly, of the Fed funds rate might be. And as we do, we see a couple of things. First, low and slow for some time. We expect the federal funds rate to move modestly through 14, through 16, through 18, until eventually it reaches a normal level of around 4% by that time. And likewise, you can see that the Treasury curve is actually quite steep today. But as time passes and rates move up, we would also expect the shape of the curve to normalize. Now, what does that mean for returns? It actually means modestly positive if this was indeed the path. Now, that's important because many investors are worried about terribly negative performance, and we wouldn't expect that to be the case, which would allow you to continue to use high-grade bonds as a ballast against difficult markets. But we also wouldn't say that's your only option. There are actually three very strong time-tested suggestions that bode very well for investors today as we try to play good defense. The first is, if you're worried about U.S. rates going up, globalize. Own multiple countries and diversify your economic cycle risk. Secondly, be balanced. We see value in credit, but we also see value in interest rates as defense, and so blend them together. And finally, be selective. Within credit, while we like it, we also don't think you should be reaching for yield at this time. And be smart about your use of interest rates. Central bank policy like those of the Federal Reserve have created steeper parts of curves which allow for gains in something called roll, the gain in the price of a bond as it ages. So in general, what we would say is our view forward is modest but positive growth, continued strength in balance sheets at corporations, particularly in the United States, and a low and slow path to normal of rates, with modestly positive returns as time passes. So for you as investors, be balanced, be global, be selective, play proper defense.